It's going to zero. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, a regional bank is nearing collapse as an imminent bank run is sparking insolvency concerns. And we've been warning about this since the banking crisis last March, that it wasn't over, that there were still more problems in the banking system, and that it was only a matter of time. I'm going to show you who this bank is, why they're facing problems, even worse, why when the word gets out of what's going on, depositors are going to outright flee, sending this bank into insolvency and a whole bunch more behind it. And if you think this is only limited to the US, well, new information now says the banking crisis is soon to spread all throughout Europe. We'll show you what the catalyst is behind this. Plus, we have a sponsor for today's show. Edge Total Intelligence is back. You can find them on the OTC under the symbol UNFYF and on the TSXV under the symbol CTRL. They're a software company, and one of the things we're really excited about is how they help drive AI integration and automation for major companies and governments, and even better, they are expected to be cash flow positive this year, which is a big catalyst behind their stock, as we're going to make the case is rallying now and can head up another 44% and show you how to take advantage of that. Stay tuned to the end of the show or check out the pinned comment or description for information. Now let's head over to Bloomberg, where he picked today's story up with the headline, New York Community Bank's credit grade is cut to junk by Moody's, suggesting when this happens that they are going to be unable to pay the debts on their bonds or face a big problem doing that, putting them down to junk status. This has caused pandemonium among investors who have been dumping their stock in a big way over the last 24 hours and even going into the market today. This is a huge problem because when the stock price of a regional bank collapses, it tells you they're near insolvency, and that means failure for this bank. Sending their stock to zero is now the base case. And the bank is facing a multifaceted financial risk and government's challenges, according to Moody's, as the ratings firm said it could go further if conditions deteriorate, dropping its rating to not just to below investment grade to Ba2. The stock has tumbled about 60% since the bank announced plans last week to slash its dividends and beef up reserves to prepare for stiffer capital rules following acquisitions that catapulted its assets beyond $100 billion. The measures followed mounting behind-the-scenes pressure from the Office of Comptroller of Currency. As we noted, the two executives overseeing risk and auditing had left in recent months. And of course, you have to know that when key players in a company leave early, that means they already know there's severe problems. They don't want to be a part of it. They don't want their name associated with it. And the fact that you have the person overseeing risk and auditing, both of them left, it tells us what's going on at New York Community Bank is more serious than even they want to admit. The bank's total liquidity stands at $37.3 billion, which exceeds the uninsured deposits, with a coverage ratio of 163%, it said. Insured and collateralized deposits, though, only represent 72% of total deposits. This is a concern as the word gets out that it doesn't have everything insured. If depositors are going to panic, they're going to remember very clearly what happened back in March when banks went insolvent and bank accounts were frozen. People couldn't get cash because they found out that their deposits were insured. The moment the word of this gets out, watch money flee out of New York Community Bank. And the client represents an opportunity for investors with an appetite for a discounted name and story with a turnaround potential. This again from Piper Sandler analyst Mark Fitzgibbon, who wrote a note to clients saying, look, buy the dip in a big way. This is an opportunity, because he doesn't believe the bank has seen meaningful deposit pressure, with the company indicating to him it has been business as usual. Well, that is until the word gets around that, in fact, all of the deposits are not insured. And memory about, again, the banking crisis is still fresh in the minds of many people who had their deposits frozen. They'll be looking to get their money out, because here we see from Zero Hedge, 33% of the deposit of this bank Well, they're uninsured, meaning, well, up to the bank's assets to cover it if they fail. Well, good luck with that. As while we heard all day about how New York Community Bank was an idiosyncratic issue, Moody's warns this is anything but generalizing the multifamily commercial real estate place being a problem. Now, we've noted on this show that it's only a matter of time before commercial real estate starts to get front page news about how the banks are sitting on a lot of upside down property, facing a massive wave of refinancing during a higher interest rate regime. Sure enough, now the focus turning to New York Community Bank because they're highly concentrated in rent-regulated multifamily properties, a segment which has historically performed well. However, this time it might be different. While vacancy rates are low for the segment, properties may face different challenges this cycle due to higher interest expense when refinanced and already higher maintenance costs due to inflationary pressures. These higher costs may prove more challenging for owners of rent-regulated properties to pass them along through rent increases to tenants. This is again putting a problem for the banks that hold these types of loans, including New York Community Bank, because beyond rent regulated, the bank has significant concentration in low fixed rate multifamily loans. This type of loan portfolio faces refinancing risk, and this is a case we're going to see over and over again. A lot of these properties have to be refinanced. The issue is their valuations have come down. Those who own the properties are going to want the banks to take a haircut. We know the banks can't afford it. That means because they're already insolvent. That is the issue here. And of course, the Fed isn't helping out, as we'll show you here in a bit, because once at $3 trillion asset class, offices are now probably worth $1.8 trillion, meaning those who hold the loan has the problem, mainly because a lot of these buildings are held in separately owned corporations from the rest of them. So if you own a bunch of these, what you do is you go out and put each building in a separate corporation. That way, if you need to default, it doesn't impact your entire company. That puts the banks under pressure here because they're the ones who typically originate interest-only loans. It's very common in commercial real estate to these buildings, and if they've lost value, well, someone has to take the pain. Well, it won't be the owner. They'll simply hand the keys back to the bank. Well, that means the losses are going to have a major impact here, as 1.2 trillion of losses have to go somewhere, and nobody knows exactly where it's all at. Well, we know a lot of it is at banks like New York Community Bank, a lot of the small and mid-sized regional banks, because Moody's warns this could end badly as a company's elevated use of market funding may limit the bank's financial flexibility in the current environment, pointing out that as of December 31st, 33% of the deposits at the banks were uninsured and could face significant funding and liquidity pressure if there is a loss in depositor confidence. Well, one thing that would do that is an outright collapse in their stock price. This is exactly what happened back at Silicon Valley Bank. Everyone started to get attention on the bank. It had problems. The stock price crashed. And the next thing you know, depositors fled in a big way. Of course, the Fed says, it's not really a big deal. We saw this was going to happen. And here we see from Jay Powell on Sunday, as we looked at larger banks' balance sheets, well, it appeared to be a manageable problem. There's some smaller and regional banks that have concentrated exposures in these areas that are challenges. And there's going to be losses. So here, you see the Fed chief said, look, someone is going to have to eat this, and it's a sizable problem that doesn't appear to have the makings of the kind of crisis things that we've seen sometimes in the past. Well, Jay Powell, failing banks are a crisis. When people lose confidence in the system that you regulate, because you are ahead, you are the head of the Fed, the Fed's in charge of the commercial banks, people lose confidence, they start pulling the money. You'll see what happened back last year in March. It will happen again, and your face will be right at the front and center, as I don't think there's much risk of a repeat of 2008, because, well, we inverted the yield curve then and we did it now, and we don't think there's a problem, because I think, we need to be careful about making proclamations about the future. There will certainly be some banks that have to be closed or merge out. Perhaps New York Community Bank will be one of those because, well, there'll be smaller banks for the most part. And these are losses. It's a secular change in the use of downtown real estate. And the result will be losses for the owners and the lenders. but it should be manageable, meaning there will be more bank failures. The Fed admits it. They acknowledge it, that they don't see a crisis here. They don't see that their inversion of the yield curve and money curves by driving short-term rates above long-term rates is causing massive problems for the banking industry that they regulate. They just don't get that they're the source of much of this pain. You see Jay Powell blaming the pandemic. Well, he's going to have a bigger problem because the banks aren't generating enough revenue to take the losses. And here we see a New York Community Bank seeks to reassure investors this today after shares hit a 27-year low. Wow, that is terrible. And we see deposits have increased since the end of last year and liquidity remains ample. Well, we'll see for how long. The company said in a statement this late yesterday, in fact, the shares have fallen about 60% since last week when the bank announced plans to slash its dividend and stockpile reserves for troubled loans tied to commercial real estate. So here we see the banks aren't saying that there's a problem in commercial real estate. One of the key points is they're starting to set money aside for losses. So that is the key part. It's not about what banks come out and say. We note this because we see the heads of banks. We talk about some of the ridiculous things they say on the show. It's about what they do. And the fact that banks are putting more money aside for loan loss reserves tells us they believe that delinquencies are going to rise and that's going to lead to more defaults, and they've got to cover those losses. Because one of the things that's impacting the banking system today that's a bit unusual is this extreme move of money out of the banking system. This is going to be a problem, of course, for New York Community Bank. Here we can note that looking past cycles where the Fed raised rates, well, deposit growth shown in red on a year-over-year rate change, well, it slowed, and there was even a brief case where it contracted here around 1993 and around 1995, but that was kind of unusual. You don't see that. Typically, when the Fed's raising rates, well, deposit growth tends to be fairly stable. This time, it went negative as people yanked their money out of the banks and went elsewhere. They went into, of course, the equity markets. They're going into CDs and bonds and other assets to generate yield, getting away from the banking system. And we talk about a loss of confidence. Well, there's one chart that tells you when the bank stocks crashed more than 60%, this morning they were believed to be stabilized until they went crumbling down even more as people look at this and they realize that, wait a minute, my money's at New York Community Bank. Well, it won't be there a whole lot longer. When the bank runs hit this watch, this will be the first casualty among many. And I just wanted you to see that the Fed says this is okay. They anticipated failures because it's not their fault. Well, indeed, Fed, it is your fault because you are not handling the regulation of the banks, which is what your primary job should be, is maintaining the health of our banking system. Instead, your focus is elsewhere. As we can see, Fed's Kashkari sees 2 to 3 rate cuts as appropriate in 2024, not realizing he's probably going to be cutting to zero. As we're not looking for better inflation data, we're just looking for additional inflation data that is also around the 2% level. If we get to see a few more months of that, well, I think it will give us a lot of confidence. Again, no mention of the banking industry. Why? Because the Fed thinks everything's fine. That's why they went and encouraging banks to go to the discount window. Hey, you need cash, no problem. Just go to the discount window. There's no negative stigma. Take all the money you want. No one will think negative of it because they don't know what happened in March and they cannot see what's happening now. And he said the labor market will dictate the speed at which the Fed lowers interest rates. Noting that the jobs market remains strong, it will give the central bank the flexibility to move slowly. Kashkari's projection of 2 to 3 rate cuts is slightly more hawkish than December's median estimate, though markets are pricing in as many 5 cuts. Well, if the banks start to go, the Fed funds rate is going to be back at zero. And the problem is this commercial real estate crisis is now starting to spread all over the world. As you can see here, the U.S. commercial real estate contagion is now moving, well, over to Europe, as now everyone realizes the problems here are everywhere else. As the latest victim was Germany's Deutsche Reef Bank, and which saw its bond slump on concerns about its exposure to the sector. It responded by issuing an unscheduled statement that it increased provisions because of the persistent weakness of the real estate markets. Again, when banks start to increase their loan loss reserves, it tells you they already are seeing problems. It could be late payments, could be missed payments. They're seeing it and they have to start setting money aside. This impacts not just the bank's profit, but it tells investors that there's something wrong in the system. And this now is just the beginning of the second round. It described the current turmoil as the, quote, greatest real estate crisis since the financial crisis. Now, I want you to remember the Fed says we should not make proclamations about the future, so we won't, except we will by saying a financial crisis is indeed coming, and the Fed didn't see it. As lenders are taking increasing provisions on debt extended to property owners and developers, as loans begin to sour, this is a key point we've made before, after rising interest rates eroded the value of buildings around the world. It's not just about rising interest rates, it's about constricting the creation of money in the system. This is the issue that the banking system is facing. This is what the Fed did, keeping the yield curve inverted for longer than it needs to be. This is going to eventually dry up all the money in the system, leading to something to fail. Now, we told you, it doesn't matter where it starts. At some point, you run out of money and some part of the financial system will start to fail, and then it will have a domino effect all around the world. And here you can see Janet Yellen said that losses in commercial real estate are a worry that will put stress on some owners, but added, well, she thinks the problem is manageable. Well, we'll see, Miss Yellen, if you think it's manageable when we're in the next financial crisis. And for offices in the U.S. where return to work following the pandemic has been slower and less substantial, the value destruction has been particularly bad. In fact, analysts at Green Street said further write-down, as much as 15%, may be needed this year, referring to write-downs by the banks. Of course, we know they have no capacity to do that. And because all of this, again, comes back to the Fed, they don't see that the reason commercial real estate prices are falling is because there isn't enough money to sustain the value of these assets. And here you can see commercial real estate prices in blue on a year-over-year rate of change. Notably, typically real estate prices are fairly steady. They grow around 2% or around 0% a year. They don't grow a lot. The key is they are a steady source of income for investors. But notably, you see periods here where the yield curve shown in red inverted underneath the dashed green line. Well, what happens is real estate prices come down. Again, not enough money to sustain the value of these properties. Here you can see the longest and deepest inversion since the 1980s. Everyone says, well, commercial real estate's okay. The reality is we know it's just a matter of time before the appraisals come in and we find out that the banks are the ones that have to eat the loss and they don't have the capacity. They have no margin for error here. Of course, that will kick off a big financial crisis, one that will likely eclipse the 2008 one. These are serious concerns in the U.S. commercial real estate market. This, according to Rabobank credit strategists, is not an issue for larger U.S. and European banks, but the smaller property-focused German banks are feeling a bit of pain. And right now it's more a profitability issue than a solvency issue for them. Well, just hang tight. They have sufficient capital and are less exposed to the threat of deposit runs than pure retail banks are. But don't worry, when one bank starts to go, there'll be another one that follows, and then it will start to snowball all across the world as depositors lose confidence even in the biggest of the banks. And if the commercial real estate losses spread to Europe through smaller German banks, that would have an echo of the 2008 global financial crisis. Back then, it was Landsbank that got in trouble when their exposure to subprime mortgages in the U.S. led to billions of euros of write-downs. Of course, we mentioned in a show recently that a Japanese bank had a lot of exposure to U.S. commercial real estate. You just don't know what banks where are holding what risk, and that is a problem. You invert these curves for too long, money dries up, and then next thing you know, the whole system starts to break. But one company that we think is breaking the mold is Edge Total Intelligence. They're on the OTC under the symbol UNFYF and on the TSXV under the symbol CTRL. in the description and pinned comment, links to everything you could want. This is a software company, as I mentioned in the beginning of the show. One of the things they do is help drive AI integration and automation, and as companies look ahead and see that they need to trim their expenses and become more efficient, they're going to be looking to Edge. And what's great is they're expected to hit profitability this year, and that means, of course, a big tailwind behind their stock, which is already rallying. I'll make the case of why I think it can go up another 44% and how you can take advantage of that. Let's take a look at Edge TI. They've been on the show before. We're glad to have them back. And their software maverick that increases an enterprise's profits and velocity to respond to business change at the speed of relevance. They're used by Fortune 500 industry-leading enterprises and government agencies. They're growing recurring revenues at greater than 40% and nearing cash flow positive operations, again expected this year. They're recognized by industry analysts for digital twins, a market growing at plus 40% CAGR, higher than artificial intelligence. And they're one of the leaders as our large enterprises and federal customers lead their industries with their platforms. Here you can see just some of the companies and service providers and governments that use Edge TI's products. Their forward AR projections and key metrics showing, again, cash flow positive this year, which is going to be fantastic. That usually is a huge catalyst behind any company's stock price. Again, on the OTC, under symbol UNFYF, on the TSXV, under CTRL. Let's look deeper here because Edge Core, this is their key software platform, gets the right information to the right people on the right device at the speed of relevance. This empowers swifter and better action. Again, used by Fortune 500 leaders in U.S. government agencies. Their well-diversified industry use, recognized in the digital twin markets, growing at plus 40% CAGR. 58% of their stock is closely held, and it's got a tight capital structure, meaning that any sort of buying behind this could send the stock price much higher. And they're scaling go-to-market through system integrators and partners. And in terms of the AI, well, success in AI requires 7 capabilities, and Edge TI, the only company in this space, has all 7 of them. You can see here, no one else compares to what Edge is, and every one of these companies is a lot bigger, which is why we're making the case that their stock price is going to head a lot higher as they head toward, of course, profitability. Here you can see after the company launched their stock, you see it came down here as sellers look to get out. And we know that when the sellers get exhausted, sometimes nothing happens other than the price just stops going down. And here you can see on not a lot of volume, the price is headed up. What does that tell you? Sellers are exhausted here. The next move from the current price back up into the last point where we see people selling was 44% from here. That is a substantial opportunity, particularly as, again, they're headed to profitability later this year. That would be a huge boom for their stock because investors love companies that are cash flow positive. And this is going to be a big story for Edge later this year. And with that, I'm Steve Van Metre. I appreciate you watching. As always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. Again, you can find Edge on the OTC on UNFYF, on the TSXV under CTRL. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.